Good evening, everyone. Welcome to the third in our series of revision sessions for financial accounting, preparing financial statements. These unit names get longer each time, don't they? This week we are going to look at task 2, and thankfully we probably managed the whole of it tonight. There's a lot of topics, but they're hopefully fairly brisk pace. So task 2 is about accounting adjustments, which briefly are everybody's favorite: accruals and prepayments, irrecoverable and doubtful debts. Used to be a lot easier to say bad debts, didn't it? And inventory, which used to be called stock. There's definitely a pattern here, isn't there? So without further ado, task 2 is about recording period end adjustments. It's worth 14 marks, and we should normally say a little bit over a minute a mark. If you go for a minute a mark, you should have time left at the end for checking. May test your knowledge of accruals and prepayments for both income and expenditure. The thing to remember here is that if it's an expenditure account, an expense, it goes one way. Income is exactly the same, but the mirror image postings apply. So it's the same process, the same logic. You may be asked to calculate an opening adjustment or a closing adjustment. Again, the same logic. An opening adjustment is the same as a closing adjustment, but it's on the other side, and we'll look at the logic of which way they go in a moment. You may be asked to work out the charge to the statement of profit or loss, which is, of course, whatever's gone through the bank for the year, plus or minus any adjustment. You may need to enter into T accounts, or you may be given sentences with gaps to fill. Yes, the key to this question, when you're preparing figures for the statement of profit or loss, it must always be 12 months worth. So if you keep that rule in mind, and that generally we'll see that you're right. 3-step process. At the start of the year, we reverse out last year's accrual or prepayment, and we'll do a bit of an example of this in a minute. Then during the course of the year, cash paid during the year is posted in, and then the final step is any closing accrual or prepayment. I suppose we could add a 4th step, which is we extract a balancing figure, and that balance figure is the one that goes to SPL if we want it. But that's the logic. Let's explore that a little bit further. So 4 situations. We can have a prepaid expense where we've paid something in advance, not yet received the goods or services. Now, the thing to remember is that if you have paid for something that you've not had, that is an asset. And an asset, of course, is always a debit. So let's do a little quick for instance. So let us say that we have rent, and during the course of the year, let us say we have paid £12,000, let's say. And let's say that, okay, let's say that here is our year. And we are told that, let's say we are told that maybe our year end is 30th of September. So we've got January, March, May, July, August, September, November. And let's say that we are told that we paid £4,000, and let's say that we paid that on 1st of September, and let's say that that covers September, October and November. So what we do is 1st of September is there, October, November. I don't know where that went. There's our year end. So sure enough, that's 1, 2, 3 months. Not picked my figures very carefully, have I? No. So we know that 1/3 equals this year, so that stays where it is, and 2/3 has to come out of this year, go forward to next year. So 4,000 times 2/3. Like I said, I didn't choose this very well, did I? What's it like when you make up your own figures and still get them wrong? £2,666.67. So what we're going to do is we are going to take 2/3 out of this year, move them into next year. So at the end of this year, we will have a prepayment. 2,667. We'll call it a PRIP. And then from rent, we have 2,666 and 67. So when we balance off at the end of the year, the amount of rent that actually goes to our statement of profit or loss is just going to be 9,333 and 33. And on our statement of financial position, we have an asset. So there, in a nutshell, is what we do with a closing prepayment. I suppose we could just run the story forward to the end of the next year. Didn't mean to do that. There we go. It helps if you leave enough room to start with. Move our year into there. When we start next year, we'll have a rent account once again. So that's this year. It's the same account, but we're showing it separately to avoid any confusion. What do we do at the start of next year? We take the prepayment out of prepayments and we put it back where it came from in the rent account, except that it's at a different time. So it's going to end up on next year's statement of profit or loss rather than this year's. And that is the process. We take it out, the prepayment comes out of this year's cost at the end of the year, appears briefly on the statement of financial position as an asset, and then goes into the rent account to reflect the fact that we have already incurred 2,667 of rent at the time of the start of next year. Before a penny has changed hands, we've already spent that money. Now, accrued expense, I'm not going to do another big worked example, but the great thing is an accrued expense is exactly the same thing, but on the other side. So if we had finished last year with rent owing, so if there was going to be an accrual, oh, we've actually said it here. In this case, an accrual at the end of the year, we would debit the expense. So we would put a debit here and we would credit the accrual, because something that we owe money for is a liability. Hence we credit it. So as we've said, prepaid income is the same as prepaid expense, the other way around again. So actually, that does mean that this one and this one have go the same way around. And likewise, logically therefore, this one and this one are the same way around. So each time you reverse it, you end up back where you started before. So if you just remember, all you're doing is you are moving income or expense out of one year and into another. And that's all it is. We like to cloak it in confusing language. Accrual is not the friendliest word. It doesn't really conjure a picture. Although in fairness, a prepayment does give you more of a fighting chance. So that's the logic of accruals and prepayments. What we got next? Oh, people who do not pay their bills. The bane of every business, the bane of every, and there can be a lot of those, I suspect, over the next 6 months or a year or two, but we better not get into philosophical issues. Important to make a distinction. A debt, an irrecoverable debt, or bad debt as we used to call it when life was simpler, is one that will not be paid. You know, you've had the letter returned, customer gone, oh, no longer at this address, gone away, or the customer's been in the news with handcuffs on, whatever, for whatever reason, you know, 100%, that's it, it's gone. Now in this case, plainly, as is the rule, we have to, under the concept of prudence, write it off straight away. So we charge it immediately as an expense, which is a debit. Every debit has to have a credit. What's gone down in value? Well, we've got a big stack of invoices. That one is no longer going to be paid. So we've got to reduce the balance of our receivables by that amount. Fairly straightforward. Now, the other possibility, rather than an absolute definite bad debt, is that a debt is doubtful. In this case, there are two situations. We can make a specific allowance if we think a particular customer is looking ropey. We've had reports in the press that a company is in difficulties, and the rumour mill says that they may not be around in the next couple of weeks. We can set aside what is called a specific provision, and essentially this is quite similar to a bad debt in that it is against one specific item. The difference is that we don't write off the invoice straight away, and we'll look at that in a minute. More likely and more commonly, and almost guaranteed to meet in your assessment, what tends to happen is the directors of our business will sit down and they will say, well, how difficult is the economy at the moment? And they'll set a percentage that they would like to set against the money owing. So they say, right, on the basis of the rumours we're hearing about the economy and what's happened in previous years, we think 5%, let's say we think 5% of our customers will probably not pay. In that case, we set aside 5% of the value of the money that's owing to us, and we haven't incurred a loss yet. But what we do, again, concept of prudence, we write down our profit as though we had, so that if and when it happens, which we think will happen, then we have already set aside the money. Now, the mechanics of this, a little bit more complicated. A single bad debt, let's just illustrate that. Here's the balance on our receivables. Let's say we've got £50,000. It's a debit because money owed to us is an asset. And let's say one customer owes us £600. Say, and we decide that customer's left town. So in that case, IRREC debts. I don't want to run out of virtual ink. So quite simply, single entry, £600. There's an expense that's going to go off to our statement of profit or loss, and £600 there. So the figure for our statement of financial position is now only, whoops, 49,400 statement of financial position. And there we go. We've reflected the reduction in the value of the asset, the true value, and we have reduced our profit by 600. Now let's look at the situation where we set aside. First of all, we'll do a specific provision. Let me use a little bit more room. Let's change color to avoid getting confused here. So in this case, we've a balance on our receivables. Let's say in this case it's 40,000. We've got one customer who owes us 2,000, and we have got serious doubts about this customer. So in this case, we will make an allowance for a specific debt, and we will put £2,000 in that, and then on the same recoverable debts, I'm saying no, there's an intermediate stage, we make an adjustment. No, we don't. We make an irrecoverable debt expense of 2,000. Now, one of two things can happen. Either the customer will pay this bill, and if the customer pays the bill, we will put the money in the bank, and we will reduce the expense of bad debts because we have no longer lost that money. On the other hand, okay, so let me do this. Okay. On the other hand, if the debt does go bad, in this case, what we will do, we'll use a different color. In this case, we will reduce the value of receivables, and we will clear that allowance, because what we've got instead is an actual bad debt. So that's the difference there. More commonly still, what we will have is, I have to work over here, a balance on our receivables, let's say 50,000, and we decide to set, let's say we decide to set a 4% allowance. In this case, we calculate 4% of the balance of our receivables, which is going to be 2,000. And we charge 4% to our adjustment to the allowance of doubtful receivables, and we create an allowance. And on the statement of financial position, the value of our receivables will be shown at the difference between those two. So we'd actually show receivables 50,000 less allowance. So our receivables are valued at 48,000 on the statement of financial position. And again, we've shown a cost to statement of profit or loss of 2,000. So that's how the mechanism enables us to show the reduction in the value of receivables. Next thing that sometimes happens is perhaps a year later, we may be told that receivables has now risen to perhaps 60,000. So if a year later our receivables is 60,000, so receivables has risen, we still want a 4% allowance. A year's time, 4% of that, we now need an allowance of 2,400. What we do in that case, we don't have to provide the 2,000 that is still in the allowance. That remains the same. All we have to do is top it up by another 400. So in year 2, the statement of profit and loss will only suffer a cost of 400. So just to make that clearer, so that would be year 2, and that would be year 1. So remember this, you don't have to provide the whole amount for every single year. You adjust up or down. If in year 3, let's say that in year 3, receivables fell, maybe we've had a very quiet year, let's say to 45,000. Now the amount of allowance we need is only 1,800. So in this case, we can reduce our allowance from 2,400 to 8. We can actually reduce that. So year 3, our statement of profit and loss will show a gain of 600. So some of the 2,400 that we've been putting aside, we can take back and put back into the profit. And again, you may get any of those situations coming up. Okay. The other adjustment we make is inventory. Period end adjustments for inventory. To make a closing inventory adjustment, we post a double entry debit inventory, which makes sense because at the end of the year, the inventory we have in our warehouse is an asset, so it's a debit. That goes on the statement of financial position. We credit closing inventory profit or loss. It's perhaps rolling back a little bit here and thinking about where we start from, because if we take a whole year, this year's closing inventory is of course next year's opening inventory. So let's think how it works. Here's our inventory account, and let's say at the start of the year we had 20,000 in inventory. Okay, and let's put over here our statement of profit and loss, and we're going to work out sales minus cost of sales. And the way we work out cost of sales, we have opening inventory, we have our purchases, we have our closing inventory, and the logic of how much we have used up is I do like to put things in old-fashioned language. 1, 2, 3. 1, we have used up everything we had at the start, plus, well, we should probably put a plus there to make it clearer, shouldn't we? Plus everything we have bought minus what's left at the end. So that's in plain English the logic of what how our cost of sales works. So what happens is our opening inventory, which I will do it in red, goes out of the inventory account at the end of the year and is used up as part of our cost of sales. We then, tell you what, let's put some numbers here. Let's use some numbers. Let's say our sales is 300,000. We add to the opening inventory everything we've bought, which is purchases. Let's say that that's 140,000 for the year. But we haven't used up whatever inventory is left at the end. And let's say we've got 22,000 left at the end. So what happens there is the closing inventory comes back into the inventory account. So the opening inventory that was there at the start has gone off and been used up as part of the cost of sales. We've used up everything we've bought, but then at the end, whatever's left over goes back into inventory. So what it's actually cost us to make our sales for this year is 138,000. So our gross profit would therefore be 162,000, the difference between the two. But if you picture that, because now a final thought. So what we can see is we know that, because the next bit is which is credits and which is debits. Now we know that sales is a credit, so we know that the costs that go against sales are debits. So opening inventory we know is a debit, purchases we know is a debit, but this one, closing inventory, is the other way because it's coming out of here. So it's a credit and it becomes a debit here. And sure enough, this is going to be a debit on the statement of financial position. So a very popular source of confusion and pain in an assessment is my closing inventory. Which do I debit? Which do I credit? Well, there's your answer. It's an asset at year end, so it's a debit to the statement of financial position. And you can see that it's a credit of profit and loss because it came out of there. Whereas the opening inventory is a debit to profit and loss because it's been put into there as a cost. Well, back to that, if you kind of think not so much how, but think about why, and then the how is not such a bad thing after all. Okay. Final thought in terms of the task before we look at some questions. Always, every section of every AAT exam, there will be little bits of ethics sprinkled about for you. Once again, to answer any questions that you might get asked, your first port of call is the word why. So we are told period end adjustments can be used to manipulate financial statements. So why might people manipulate results? One option to make results look better. Well, why might a director want to make results look better? There might be a bonus to be had for somebody. We maybe want to persuade the bank to lend us some money, perhaps. So there are reasons to make results look better. There was a report on the news recently about someone who shall remain nameless, but is quite a well-known recent American president, who has a lot of property interests, who reported the value of his property in a big block of apartments, flats. Now, the dearest flat that had ever been sold in that block sold for, I believe, $27 million. So it's a nice block of flats. He'd valued his, for the purpose of the business books, at 380, I think the figure was, which is a bit more than the average. So this was allegedly to enable them to borrow money against it. So that's why you might look at better. Why, alternately, might the directors want the accounts to look worse? Well, obviously, the more profit you make, the more tax you pay. So the other thing is, those are things that people might want to achieve. You may get a short scenario where it says you've been asked to put this through in the wrong year to increase or reduce an expense. And again, simple answer in an exam is just say no, and try and make sure you can remember which of the principles applies. Pressure from anybody else is a threat to objectivity. If you've something to gain, then it tends to be integrity. Confidentiality doesn't really apply to manipulation, nor does professional behavior, nor does professional competence. That's more about ability to do the job. So make sure you know your principles, and if it's not clear, well, why would somebody want to do that? Think about what they've got to gain or lose. Let's have a look at a question. So, we've got trues and falses now. Trues and falses. Okay. Inventory should be valued at the higher of cost or net realizable value. Net realizable value is what you are going to turn it into when you sell it. So if you can sell it for a tenner, but you've got to spend £2 before you can sell it, then you're going to turn it into 8. Well, anybody see the problem word in this statement? Any offers in the chat box for the problem word? I'll show it. That's the problem word. So that is indeed false. Okay. Second statement. Inventory items can be valued using either last in, first out, LIFO, or average weighted average cost, AVCO. The other one, of course, not got to mention here, is FIFO. Now, it is correct that 2 of those are permitted. The ones that are permitted are, in fact, AVCO and FIFO, so that is also false. Costs of storage for finished goods. So this is the cost of renting our warehouse, paying the people to operate it. Indeed, not included. That is true. That is true. Net realizable value is the sales price of the inventory. Good start. Plus any costs needed to complete the sale. So let's think about this logically. I've already given the example. If we have something that we sell for £10, but we've got to spend £2 before we can sell it, so we're going to turn it into £8. Is it reasonable to combine those and say that its value, its net realizable value, we're going to turn it into is £12? I think not. So the problem word there is plus. That should be minus. Now, got to be careful with the next one. If there are items on the premises that have been sold and are ready for dispatch, we do not include these in the inventory valuation. The key point is, if we have raised the invoice, then the value of those has been dealt with and has gone elsewhere in our accounts. If we have yet to raise the invoice, that's different. Ready for dispatch to me suggests that they're all invoiced, they're all packaged up, we're just waiting for the van to come. So I think we would put that as a true. You are working on the accounting records of a business for the year ended 31st of August 20-something 6, and we can ignore VAT, which does make life a bit simpler. Right, so on the 1st of March 20x6, the business paid £2,900 in respect of its rental expense for the period ended 28th of February 20x7. Now 20x7 is a long way after 20x6. So we need to do something about that. Okay, we're going to have to split that, aren't we? So here's what we do. Here's a year. Whoops. Not sure where my line went then. We're starting in March. We've paid this in March, April, May, June, July, August, October, November, December, January, February. So that's the period of time that our rent covers. And we paid it. Our year end is at the end of August. So that's our year end. So sure enough, I can see that there are 6 months before and 6 months after. Nice and easy. A very popular error here. People will say, August, that's the 8th month. March, that's the 3rd month. 8 and 3, that's 5 months. Very, very popular error, because what we're not taking account of is from the first of one month to the end of another. That's an extra month. If you draw yourself a timeline every time, you'll never get these wrong. So 6/12 of 2900 is half, isn't it? So we know that 1450 of that, now it's paid this year, half of that relates to next year. So we have already paid a chunk of next year, so it's prepaid. The bank summary shows £11,200 in relation to light and heat. That's what's going to be like in our houses soon, isn't it? However, during October 2006, an invoice was received in relation to the quarter ended 30th of September. Right. So we've got another one to do, haven't we? Well, we can do the same timeline. It works just as well, doesn't it? So that one is August, that one is September, June, July, September, October, November. So there's our year end again. Now, so it relates to the quarter ended, well, there's the 30th of September, and a quarter is 3 months. So in fact, 2 months are before, 1 month is after. So 2/3 of 7,200, a third of that is 2,400. So 2 of those have got to be added in to this year, and the other third can stay where it is in next year. So this is something that we have had the benefit of. We've used up. We haven't paid for it. We owe for it. We've got to accrue. So in that case, 4,800 is going to be accrued. Now, next job is to prepare the rental expense. There's a bit more down below, I think, for the year ended. Okay, so on the now look carefully. So at the start of the year, we'd already paid some of this year's rent. So last year we took it out of last year and we're moving it to this to take out of last year's expense, credit last year, therefore it's a debit this year. So we have I'll call it an opening prepayment for clarity, 1,200. 1st of March, out of the bank, we have spent 2,900. At the end of the year, our closing prepayment takes money out of this year, moves it to next year, 1,450. So the greater of the two sides plainly is that one. That's 4,100. Our balancing figure a splash of colour. To our SPL 2650. So far, so good. Okay. Oh, we're supposed to use, with these are actually a pick list, we should have used balance brought down and SPL. Notice the one that we don't use, the one that you do not use, with this, we don't use a carry down because it goes to the statement of profit loss. Instead, it isn't carried down, it is cleared to 0. So I've got to be careful of that. Okay. Now, what's a bit further down? No, there isn't. Oh, didn't I put the data on the next page as well? I did. Same data, right. We've already worked it out. So we've said that 4,800 of that is accrued. So we have an opening, right? So let's do our light and heat. L and H. We have an opening accrual, which means that some of what we spend this year doesn't relate to this year. It's going out of this year and back to the previous year. So our opening accrual, we would really put that will be, for clarity, opening accrual 2,400. During the course of the year, we are spending 11,200. But in addition to that, we are adding some extra cost for which we have not yet paid. So once again, let's balance it off. That's nice and neat, 16,000. So that's going to be, well, no, it isn't. That's going to be 16,000. So that's going to be 13,600. So our answer for that, 13,600. What impact would there be on the accounts if accruals were not posted? Now, given that the time in the world at which we post accruals is the end of the year, we have to assume we're talking about it closing accruals at this point. So we have said that closing accrual increases expense. So if it were not posted, this is going to understate our expenses. So that's got to be one of our answers, hasn't it? Because we take that out of there, we've only then got 9,000. So the second one can't be true as well, because that's the polar opposite. Liabilities would be understated, liabilities would be overstated. So a closing accrual is something that we owe, it's a liability. If we don't post it, we are going to understate liabilities. And given that an expense and a liability kind of arise at the same moment, that's kind of logical too. Hopefully what's coming through on tonight's session is, if you focus on the mechanics, think of it in terms of here's how an expense works. I'm taking a bit out, I'm moving it, I'm adding a bit in. That really is the key to cracking this subject. So thank you everybody for attending tonight. I'm going to stop recording at this point. If anybody has any questions, I'll be around just for a minute or two.